Imagine slashing thousands off your dream home right now. Will the Federal Reserve just drop interest rates on September 17th, 2025? But is this your cue to buy? On September 17th, 2025, the Federal Reserve may announce a pivotal 25 basis point cut to its benchmark federal funds rate, which may lower it from a range of 4.25% to 4.50% to 4.00% to 4.25%. This will mark the first reduction of the year, following 5 consecutive holds since December 2024. According to a Reuters poll of 107 economists, nearly all anticipated this move, driven by softening economic signals. It's a 0.25% shift, but in the world of borrowing, it ripples far and wide. So why now? The Federal Reserve's dual mandate, stable prices and maximum employment, tipped the scales. Recent data painted a picture of a cooling labor market. August's jobs report revealed just 35,000 new hires, far below expectations, with revisions slashing prior month's figures by over 100,000. Unemployment holds at a low 4.2%, but hiring has slowed dramatically, raising fears of a downturn. Inflation, while down from peaks, lingers around 3%, a full point above the Fed's 2% target, fueled partly by economic uncertainty, which added upward pressure on prices. Fed Governor Christopher Waller cited these rising downside risks in the labor sector, arguing for cuts to prevent a recession, even as core inflation metrics like PCE hover stubbornly high. In essence, the Fed is acting preemptively. With policy lags taking months to bite, this cut aims to shore up jobs before weakness deepens, balancing inflation concerns against economic fragility. For the broader economy, this cut is a gentle nudge towards stimulus. Lower rates reduce borrowing costs for businesses and consumers, potentially boosting spending and investment. Expect a modest lift in GDP growth, perhaps adding 0.2-0.3% to 2025 forecasts, as credit card and auto loan rates dip, freeing up household cash. Stock markets may rally, with sectors like tech and real estate leading, as cheaper capital fuels expansion. However, savers face slimmer returns on deposits, and if inflation doesn't cool further, we could see volatility. Overall, it's a bid for a soft landing, averting recession while taming prices, though tariffs could complicate the path ahead. Now, the real estate angle, your niche. Mortgage rates, already tumbling to an average 6.35% for 30-year fixed as of September 11th, could ease further to around 6.2% post-cut, per Freddie McDyter. This makes homes more affordable. On a $400,000 loan, that's roughly $150 less per month in payments. Demand may surge from first-time buyers and refinancers, potentially increasing sales by 5 to 10% in Q4, while spurring construction as builders access cheaper loans. Home prices, up 3% year over year, might stabilize or rise modestly in hot markets, but affordability gaps persist in high-cost areas. It's a thaw for a frozen market, but inventory shortages mean no fire sale yet. Sellers, this could be your moment to list. Looking ahead, yes, further drops seem likely. Markets price in at least one more 25 basis point cut by December 2025, with a 60% chance of 50 basis points total this year, per CME FedWatch. Analysts at Morningstar forecast rates nearing 3.5% by mid-2026, assuming labor softens without spiking inflation. But watch inflation reports and tariffs. If prices re-accelerate, cuts could pause. The Fed's path is data-dependent, but the trajectory points downward for now. With rates falling, now's the time to know your home's worth in this shifting market. Click the link in the description for a free valuation. Don't miss out on potential gains.
Your ultimate hub for real estate insights, breaking news, entrepreneurial wisdom, investing strategies, and self-development hacks. If you're ready to expand your mind and stay ahead of the game floor, you're in the right place. Subscribe now. Your future self will thank you.